property casualty carriers and agencies have been hit with not only financial crisis, but also a steady string of catastrophe losses in 2008. Joseph R. Lebens has been watching 2008 results for the property casualty insurance industry closely. As a principal for the insurance consulting business of Towers Perrin, he and his firm advise insurers on what is happening in the industry and how to improve results. So Insurance Journal's Andy Simpson asked Joe what lessons might be learned from the difficult year that was 2008. For one, what is the pricing lesson? Most insurance prices did not harden much as 2008 wound down. Exceptions were some reinsurance prices, as well as directors' and officers' liability prices for financial institutions. Given the financial crisis and the catastrophe losses, how could prices not be firming?
We're still puzzled over that a little bit. The competitive pressures that are out there, there's still capital that wants to flow into the marketplace, even though the industry has lost a lot of capital. That combined with the competitive pressures are forcing some prices still to soften. Only in pockets are we seeing any hardening or increases.
Lebens is not just watching commercial lines, but personal lines business as well. Here, 2008's catastrophes and gas price fluctuations are likely to influence what happens next.
Well, personal lines clearly affected by the catastrophe losses in the Midwest earlier in the year and throughout the summer, the hurricanes, Ike, for example. So in the homeowner marketplace, we expect to see poor combined ratios as a result of the hurricanes and the weather-related losses. The prices with regard to what will happen with the prices going forward in 2009, we expect that some firming has to take place in the homeowners line of business. The auto line of business, it's interesting. We've seen claim frequencies declining still throughout 2008. During the summer months, when the price of gas was $4 or $5 a gallon, people were driving less, and therefore there were fewer auto accidents. And now the gas prices have dropped again. We think, oh geez, maybe people will start driving some more again. There's clearly a correlation between the miles driven and the claim frequency. So the auto line of business is still, from a claim frequency standpoint, the jury's still out, again, I'll say. And prices there's just been very strong competitive pressures continuing for the personal auto line of business.
So there was a lot going on in 2008 for the property casualty insurance industry to monitor and absorb. Much of what happened demonstrated again how intertwined the industry is with Mother Nature, and with what is turning out to be the mother of all recessions. These are risks the industry and its customers must manage going forward. Is the industry paying attention? We asked Towers Perrin's Lebens what lessons insurance carriers and brokers might learn from 2008.
The lessons from 2008, I think, starting at the top would be that catastrophe risk management is still of paramount importance. Reliance solely on the catastrophe models, however, is not, while it's a good practice, it's not the only information management and companies should use with regard to risk management. The models have proven to be useful, however, they are just a tool, and complete reliance on the models is not a prudent risk management. Management should use the models as information and still make the right decisions based on that information. Enterprise risk management certainly came to the forefront in 2008. A lot of people are saying that enterprise risk management has failed during the year because of the troubles we've seen with certain companies and the industry more broadly. We don't view it as a failure of risk management, but rather in risk management. Risk management is still a prudent exercise for companies to go through. Companies rely on models, catastrophe risk models, economic capital models, and total reliance on the models is while it's useful information, total reliance is not the proper way to manage risk.